In this video, I'm going to show you how to combine all of the smart money concept as confluences to pick quality and high probability trades. Now, the smart money concept is one of the most popular and the most profitable trading strategy if you know what you're doing. In this video, I'm going to explain the concept one after the other so you can have a broad understanding of this concept and level up your trading game. All right. Now, so what is smart money? As the smart money concept, which is often called the SMC, is a trading strategy that involves following the behavior of large investors. Now, these investors include the big banks, the hedge funds, the financial institutions, right, to make profit. We simply try to analyze the way these big banks enter into the market, how they exit the market, right? And then we pick trades from their entry point and exit the trade as well from their exit point, right? So we can ride on their strength, all right? Because they actually they are the market makers, the market movers. They come into the market with lots of liquidity to move the market, right? So the SMC strategy or the SMC concept is based on the idea that these investors manipulate prices and liquidity, right? Now, we have the core concept of these smart money, and the concepts are the number one. We are going to look at this concept one after the other, and I'm going to show you how to combine all of these things, right, to build quality trades on your chart. Right. So guys, before we go ahead with this video, if you like this type of videos that help you level up your trading game and to help you also get rich trading, simply click on the subscribe button and also click on the like button as well to help the channel grow. So thank you so much. So the number one concept we have here is liquidity grab and stop loss hunt, right? Now this is where institutions target retail traders stop losses to fuel their own position. Now, how this works is before the smart money guys enter into the market, they would want to buy price at a lower point, right? And they also want to sell at a higher point. So let's say the price is trending this way, right? Let's say price is moving this way. Now, if the smart money guys want to enter into the market, they'll probably drive price all the way down to this zone here or to this other block here or imbalances here, right? Now, why price is retracing, price is taking liquidities, right? Because a lot of people, for example, if there is an imbalance around this zone, that means someone actually took a trade, right? Because there are some traders, they are using imbalance as their entry, right? And just the low of the imbalance as their exit. So if price decides to retrace to this order block, it means such traders are going to get stop losses, right? And if, for example, if price decides to take this low out before another push to the upside, it means those that trade order blocks are also going to be affected as well, right? So what the SMC guys do is they try to go after the liquidity in the market before they actually pick their positions, right? So that's what we refer to as the liquidity grab or stop loss hunt, right? Now, the next thing is the market structure. Market structure is, identifying the trends in the market, the breakout structure, the change of character, and, the overall trend direction, right? The next thing here is the order blocks. The order blocks are the key areas where institution place large orders leading to price reaction. Oftentimes, price react impulsively from order blocks. The number four here is the fair value gaps. Now, fair value gaps, some persons call it liquidity void, some persons call it imbalance, right? Now, it's still the same thing. Now, the fair value gaps, there are imbalances in price that the market tends to feel before continuing in price, right? So market always tends to come back to feel imbalance because the market seeks efficiency. The market seeks efficiency between the buyers and the sellers, right? Now, the fifth thing here is inducement. Now, this is a trap. Inducement simply means trap, right? It is a setup that tricks retail traders before the next move, right? They want to take you out first, get you to take a wrong position so they can use you as liquidity before they eventually pick up their position, right? And then we have the breaker blocks. Now, the breaker blocks are failed order blocks, right? That now serves as either a support or a resistance, depending on the trend, right? Now, so let's look at each of these concepts one after the other, and afterwards, we are going to combine all of them to pick quality trades. So ensure you watch this video to the very end so you can have a very, very deep understanding of these concepts, all right? So we'll start with liquidity. So what is liquidity? So liquidity simply means money, right? Liquidity simply means money. Now, liquidity, it's an area where we have lots of pending orders, right? Now, pending orders are orders waiting to be mitigated. Orders are a lot of people that want to enter into the market. Either it's a buy order, right, from an order block, or it's a sell order, right, depending on the trend, right? So in an area where there are lots of orders, stop losses, where there are buy stops and sell stops, right? Where all of these orders are stacked, right? Institutional traders target these areas to fill their positions, right? And we have types of liquidity. Now we have the number one here is the swing highs and lows, right? Now let me just quickly explain these swing highs and lows because it's important. So let's say we have a market moving this way, right? We have a market moving this way. Now this zone here, this higher low here, this higher low here, and this new higher high is our new swing, right? Now we have two type of swing liquidity. Now this move here, this move from this zone to this zone, this is our external liquidity. Now, if you agree with me, you're also going to see moves like this, right? Retracement like this before price eventually moves up, right? To create another higher high to continue the trend, right? Now, this move from here to this zone is the external liquidity. Why this retracement within this higher high and this higher low, within this our swing structure here is the internal liquidity, right? Now, so the internal liquidity and the external liquidity of the swing, what we refer to as what as the swing liquidity. So price, whenever price retraces, for example, this swing, this external liquidity, you're going to have maybe imbalances, you have order block, right? And lots of things. Yeah, maybe you have probably a breaker block and all of that, right? So these are what makes the swing liquidity. And also we have the equal highs and the equal lows, right? Now, let's say price is moving this way, right? Let's say price is moving this way. We refer to this as a ranging market when price is just moving sideways without any impulsive move. Now, if you agree with me, this zone here, lots of stop losses are this zone, right? Because this now this is more like this is multiple consolidation, right? Where we have three equal highs here, right? One, two, three. Now at each of these points here, traders entered into the market, right? So we have our stop loss for the first people that entered into the market, stop loss one, stop loss two, stop loss three, right? For the sellers, right? And also for the buyers, we also have the same thing, right? We have our stop loss one, stop loss two, stop loss three, stop loss four, right? So it means a lot of people entered from here, from here, from here, from here. Now, so you can see that lots of liquidity, lots of orders, sell orders and buy orders are stacked here, right? Now, so what will price do? Now, if the smart money guys want to enter into the market, what they will do is they want to grab liquidity from both sides, right? They want to drive price down so that they can buy at a lower price and then push price up, right? So that they can then sell the market, dump the market at a very high price, right? So what they'll do is they will come into the market, do something like this, giving these last buyers hope, right, that the market is going up. Then they'll do something like this. They'll bring it down here. Now, when this happens, it means all of these sellers, all of these buyers here, their liquidity has been taken, right? Now, so that's huge liquidity that has been taken. Now, when this happens, a lot of people that have taken losses here, all of these buyers that took losses here, right? They are going to now believe that, okay, price is now moving to the downside. Now, those that are selling here, they are going to be happy. They are going to be so happy because they'll be like, okay, we finally have a breakout. So what are we going to do? We are just going to hold our position until price move down significantly, right? So we can make maximum profit. And those that took losses here, the buyers that took losses, since this breakout has happened to the downside, they are now going to believe that, okay, price has broken down to the downside, which means let's take sell positions. So what are they going to start looking for? They will be looking for the order block that was responsible for this break. Some persons are going to place their entry here. Some persons are going to consider this zone here, right? Or some persons are going to consider imbalance. Now, this is the order block, right? Some persons are going to consider imbalance here, right? So you can see these are now the three entries which traders can, enter into the market, right? Some persons can use this breaker block here, right? Some persons can use the breaker block here as their entry. So you can see that 4 entry points here for traders. Now, and each of these entry comes with their own stop losses, right? Stop losses at the top, stop losses are above this high, stop losses above this imbalance, stop losses above this high here, right? Now, so you can see everyone is now in the market, right? Before it was just the buyers and buyers and the sellers, but now everyone is now selling the market. Now, so what these smart money traders will do next is they'll pick their buy positions here, right? And remember they started selling from here, right? Now they'll pick a buy position here and they'll drive everyone out. So while price is coming to this zone, price will activate this person's order, right? And give the person stop loss. Price will activate this person's order, give the person stop loss, activate this person's order, give a stop loss, activate this order, and also give a stop loss. And then price will just continue moving up to the point where they are satisfied, and then they can decide to exit the market, right? And then you see price retracing all the way down again. So this is how the smart money concept, guys, use these equal highs and lows, for liquidity. Now, the next thing we have here is what is trend line liquidity. Now, trend line liquidity is when price is moving this way. Let's say price is moving this way, in this type of way, right? Let's say you can see here, this is a trend line. Now, the trend line is more like, just look how these lines align here, yeah? You're going to have something like this. Let me push this back a bit. Yes. Now, below this liquidity, right, is lots of traders stop losses. Now, why did I say that? Because look, this is a higher low, right? This is a higher low. A lot of people actually took their trade from the. A lot of people have their trade here, right? They are waiting. Some persons are waiting for price to retrace to this zone before they can pick a trade. Some persons actually took a trade here, right? Okay, let's even say price came down to an order block. Let's say price even visited all of this order block, right? Let's see something like this happen, right? Let's see something like this happen where price visits the order blocks, right? Yes, so let's do something like this. Now, if price visited this order block, you're going to agree with me that a lot of people enter into the market from here, right? From this order block here. A lot of people also enter into the market here from this order block. A lot of people also enter into the market from this order block, right? So we have our buyer one, our buyer two, our buyer three, right? And let's say there is actually an ultimate high where they are targeting. Let's say this is our ultimate high. So they want to actually hold this position to that high so that everyone will take profit, right? Although the greedy one will still be in the market. But instead of price to get to this high so that everybody can take their profit and rest, price will then decide to take out this trend line, right? Price will start to take out all the liquidity on this trend line. So when price breaks this trend line, price has sweep massive liquidity, right? And afterwards, price can then decide to either continue going up or just continue going down, right? So that's all about trend and liquidity. And then we have the other block. The other block is what I just explained, right? These zones here that leads to impulsive move, right? These zones that leads to impulsive move. Let me move this here. The other blocks, they are usually, at the base. They are the base of a trend, right? They are always at the base of an impulsive move, right? Now, this impulsive move here, this is an order block. This is an order block as well, right? So we are going to talk in detail about order blocks, so I'll not go into detail right now. Then we also have imbalances, right? And imbalances, we're also going to talk about imbalance, so I will not talk about, we're also going to talk about breaker blocks, right? But all of these zones here are where price, peaks liquidity in the market, right? So let's quickly go to the next concept, right? Now, guys, remember I said at the end of this, before the end of this video, I'm going to show you guys the chart examples of all these things I just said, right? So just don't go nowhere. Watch till the end so you can have a better understanding, right? So let's look at the next one. The next one is market structure, right? So what is a market structure? Market structure refers to how price moves from one trend, to form trends, right? Ranges and key levels on chart, right? How price moves to form trends, ranges, and key levels on chart, right? And the key components of trends of the market structure is number one is the trend, right? And we have different type of trends. We have the bullish trend, the bearish trend, and the ranging market. right? The ranging market is what we just talked about when we talked about equal highs and lows, right? And we have now the bullish trend, which is also called the uptrend, is characterized by higher highs and higher lows. Now, this is what an uptrend means. This is what the bullish trend means when price just continue going up, right? And when price does this, each of these zone here, this is a higher high, and this zone here is, sorry, this is a higher high, and then this here is a higher low, right? This is a higher high, this is a higher low. So each of these points here, let me just use this, higher high, higher low, higher high, higher low, higher high, right? Now, so if you want to label it, you can just label it as, HH or whatever. Do I have it here? I don't think I have it. But if you want to label this, you can just label it as, let's say I want to label this zone, I'll just, HH, which means higher highs, right? And here is the higher low. Now, the next thing here is the bearish trend, right? The bearish trend means the downtrend. Now, the bearish trend is also referred to as a downtrend, right? And the downtrend is characterized by lower highs and lower lows, right? So just the inverse of what we just did, right? Just the inverse of what we just did, where you have a market moving this way, right? You have a market moving this way. Now, this zone here, this is the lower high and the lower low, lower high and the lower low, right? And here we have our breakup structure. So this is our new low, lower low, lower low. Now it's called lower low because the new low is always lower than the previous low, right? Just like in this scenario, the higher high, the new high formed is always higher than the previous high. And the new higher low formed is also higher than the previous low, right? So that's how you know or identify a trend, be it a bearish or a downtrend trend, right? And then the next thing we talk about here is the ranging market. The ranging market is what I just told us about, right? Where we have market moving this way, moving this way, moving this way, right? Now you can have this is a multiple consolidation, right? This is multiple consolidation or ranging. We can also have double. We can have double, right? And we can also have single, right? Where price move from one point to the other, right? So we can have multiple single and double consolidation. The ranging market is referred to as a consolidation, right? When price moves sideways without any impulsive move to break out of the range, right? So these are the three types of trend we have in the market. Now, the next thing we have here is the break of structure, right? The break of structure is when price breaks a previous high or low, signaling trend continuation, right? Now that's what I just did here. Whenever price takes out a new high, the old high that was formed, we say it's a break of structure, right? This is a break of structure. Why is it a break of structure? Because price just took out the high that was formed, right? Price just took the previous high to give us a new high, right? And also in this situation, this is a break of structure as well. And break of structure, guys, break of structure is positive, right? Break of structure is positive because they signal possible trend continuation, right? Possible trend continuation. So they are positive, right? So whenever you're having break of structures, so know that the market is going in a specified direction. And then the next thing we have is a change of character. Okay, now what is a change of character? Change of character is when price change direction, right? Let's say a market that was moving this way, going up, creating series of higher highs and higher lows, all of a sudden decide to take this last higher low that created this higher high, right? When this happens, we say a change of character has happened, right? And when the change of character happened, it signals change of direction. Change of direction. It means market is about to reverse to the opposite direction. So this is our change of character. At this point here, we say this is a change of character, right? So so what do we expect? We expect price to start moving this way, and then just keep going down, right, to create lots of BOS to the downside since we have a new trend, right? So that's a break of structure. Now, but the most valid type of break of structure is when you already have the most valid type of break of structure is when you have already two structures taken out, right? Let's say, for example, after price took out this, price then decide to do something like this and then go ahead and take out this low, right? Once this happens, it is a very strong indication that price has indeed changed trend. And only what you'll be looking for in this type of market is sales, right? You'll be looking for sales down here, right? So the next thing we'll talk about is support and resistance. Support and resistance. Okay. Now, what is it? What is a support? Now, support is a price level where demand is strong enough to stop a decline, right? Where demand is strong enough to stop a decline. Let me just clear this quickly. So let me just give us where price is strong enough to stop a decline. Let's say, for example, you have price moving this way, right? And then when instead of price to break this low to continue this trend down here, price decide to react from this zone and go up. Maybe come some other time again, react from this zone and then go up again, right? So it means when this happens, we refer to this zone now as what as our support, right? Why? Because it seems this zone here is preventing price, the demand here, right? The amount of orders in this zone is so strong that it prevents price from breaking down here, right? To give the sellers advantage in the market, right? So we refer to this zone as the support zone, right? The support always prevent price from prevent price from dropping further, right? And also we have the resistance. Now the resistance is the opposite of the support, right? The resistance is a price level where selling pressure prevents further price increase. Let's say, for example, let's use the same example here. Let's say price just keeps rejecting from this zone. If price keeps rejecting from this zone, it means here is our support zone, it's our resistance zone, right? Because price will not because this zone here, the supply here will not let price to continue increasing. Instead, it will always reject price down, right? So that is what a resistance and a support zone means. Now, so guys, let's quickly go to the next concept. The next concept we're going to talk about here is order blocks, right? Let's talk about order blocks. Now, what are order blocks? Order blocks are key price zones where institutional traders place trades, right? Sorry, this is supposed to place trades or place their orders, right? It's the same thing, right? So this zone is where, in fact, order block is the most used zone by the smart money traders, right? So if you're a smart money trader, you would want to understand deeply what an order block is. I actually have a video on order block. I'm going to probably leave the link in the description, right? So you can have an in-depth understanding of what an order block is. Guys, if at this point you've not subscribed, please go ahead and click on the subscribe button. And also please click on the like button as well, right? Just to help this channel. So the order blocks are key price zones where institutional traders place trades, right? Now, they are crucial concept to the smart money and help traders identify potential reversal or continuation points in the market. Now, we have two types of order blocks. We have the bullish order block, right, which we refer to as the demand zone, found at the base of a strong bullish move. It indicates buying, right? So let's say we have, like I already told us, we have a trend this way. If we have a trend this way, right? At the base of each of these impulsive move here is an order block, right? So this order blocks is the most interesting area for smart money traders to actually pick trades, right? So, and the bullish order block here is the last candle before this move to the upside. So the last candle before this impulsive move to the upside is what we refer to as our order block. And also this zone here as well, the last candle before this push to the upside right? The very last candle before this momentum push, right? You can also say it is the last sell candle, right? Before the buys, the last sell candle that handle the buys, right? But sometimes you can also have, that's why I just said the last candle, right? But you can simply just say it is the last bearish candle, the last sell candle before the push to the upside, right? So let me not confuse you guys. And also for the sell scenario as well, for the sell scenario, we have price this way, right? Let's say we have price this way. It's also going to be the last candle here, the last candle here before this sell, the last candle before this sell, this push to the downside. That's our order block. That's our order block. Now, when we go to the chart, I'm going to show you guys all of these things. So for now, just keep taking notes, right? Now, so this order block here, this one I just described now is our bearish order block, and it is found at the top of bearish moves, right? It indicates selling, just like I showed us here, right? It indicates selling. Now, how do you identify valid order blocks? The number one, ensure there is an impulsive move. Look at the order blocks I used in this scenario. You can see how price moved impulsively afterwards, right? They have to be an impulsive move to the upside, right? Leaving behind imbalances, leaving behind spaces in between candles, right? Spaces in between candles. So if your order block does not have an imbalance, it's not so valid, right? Now, the reason why we consider order blocks with imbalance is that they push the kind of liquidity that pumped price from that zone can be dependable, right? You can depend on that type of liquidity. You can depend on price to react from that zone again, right? And give us a push to the upside. So that's why, because price has so much power to push, and are not allowing candles to overlap themselves. So that kind of power that price has from that zone is what we are banking on, right? And that's why we are taking our trade from that zone. So also you need to check for market structure shift, right? Ensure that your order block breaks structure. Any other block you're selecting, ensure there is a break, a change of character or a break of structure before you consider that order block to be valid. Your order block has to have a change of character or a break of structure, else that order block is not valid, right? Then the next thing here is identify the last candle before the move. I just explained it. This is the last candle before this move, that is the order block. And then what do? You wait for price to return to the order block before you place your trade. You wait for price to retrace here, and then you take your trade to continue the trend, right? So we'll look at chart examples of all I just described now. So let's quickly go to the next concept, right? Now, the next concept we'll look at here is the imbalance. Imbalance. Now, the imbalance is a very, very important concept as well, right? So imbalance refers to areas on price chart where there was a rapid movement in one direction, leaving little to no opposing orders, right? Now, when price creates imbalance, it doesn't give room to the opposing party. Let's say, for example, a trending market, price moving impulsively this way, not giving the candles the room to overlap themselves, right? It means this type of market is not, is not efficient, right? Because price is not paying attention to the sellers. And if this continue for a long time, the sellers are going to, eventually just leave the market, right? And price is not going to keep trending upwards. And that will become a very, very unhealthy market. So what price will do is price would want to encourage the sellers to also participate, right? So that price can get more liquidity, so that price can just keep taking their stop losses to have enough momentum to keep going, right? So that's why price always seeks efficiency, equality between the buyers and the sellers, right? So this typically creates a gap or an inefficient price movement that the market tends to revisit later to rebalance price action, right? Now, why is imbalance important in trading? Number one, price tends to fill imbalances. Like I already said, price will always tend to reverse, right? If there's an imbalance here, price will reverse, to fill up this imbalance, because price seeks efficiency, right? Meaning price often retraces to fill this imbalance before continuing its trend. The number two reason is key areas for institutional activity, right? Imbalances often occur due to institutional buying or selling. Like I already told us, An order block here is what we usually sponsor an imbalance, right? And for the imbalance to be formed, it means huge order has been pumped in, huge liquidity has been pumped into the market, right? So price will always seek to come back to retrace and correct the imbalance, right? So, or identifying the imbalance here alone also shows that the big trade has actually entered the market from this zone, right? So you'd want to, this will help you to show you, or this shows the activity of the smart money traders, right? And also the SMC traders use them to identify where big players have left unfinished business. I just said that, right? So the number three thing here is it adds imbalance, adds as confluence with other trading concepts. Like I already said, if you have an order block that is preceded by an imbalance, it means that order block is very valid, right? So you use this order block as a confluence, right? With other concepts, so you can take quality trades, right? Imbalance align well with supply and demand zones, order block and liquidity areas, strengthening trade setups. It makes our setup more reliable, right? And then the number four is risk management and trade entries. Traders use imbalance as target or entry points, refining stop losses, placement, and improving risk to reward ratio, right? So yeah, instead of I think that's actually self-explanatory, right? When you use imbalance, if you use imbalance as your entry, for example, yeah, it reduces your risk to reward because imbalance are often not very wide, right? Let's say you have an imbalance that's this wide. Let's say you have an imbalance that's this wide, right? If you place your trade here, you're going to have, let's say you place a buy position here from the start of this imbalance, right, to the end of the imbalance. Any slight move that price make, you're already having so much risk to reward, right? Because imbalance are usually not very, very big. In most cases, they are usually not very, very big. So you already know that you're going to have tight stop losses and a good risk to reward. So it helps increase our risk to reward for those that trade off from from imbalances. Guys, so let's quickly run to the next one, which is the next one here is what is the breaker block. Yes, the breaker block. Now, what is a breaker block? The breaker block is a failed order block, right? When an order block fails, it gives us a breaker block. Why is it not coming up? Let me try again. Okay, yes. Now, a breaker block is a failed order block that occurs when price breaks through a previous high or low, right? This can indicate a potential reversal or trend continuation. Now, what does that mean? Let me just quickly show us what a breaker block is. Let's say you have price trending this way, and all of a sudden price decides to break this low here, right? Now, this is a change of character, right? Now, what do you expect price to do? Some persons will expect price to go to this order block here, but that's not what price will do most of the time, right? Rather, price will react from this zone here and sell off, right? Now, this zone here is what the last candle here, is the breaker block because this was the order block that was remember the order block that was responsible for this BOS, yeah? This order block was responsible for this BOS, and now price has taken it out, right? Now, so it's going to give more like he's going to fight just his last fight before he becomes useless, right? Now, price has taken advantage of it by breaking to the other side. So this other block here is going to, retaliate, right? By just, becoming a force for the very last time before it eventually become very useless, right? So price will honor it and more like let me just say price apologizing for breaking it out, right? So when price take this out, price is going to apologize by coming to this zone and say, okay, sorry, I'm sorry, order block, see you no more, right? And then price is going to continue selling, right? So this is what a breaker block is. Now, this is for a change of trend, right? We can also have a breaker block for trend continuation as well, right? For trend continuation. So let's say you have a new trend here, right? You have a new trend. Price was coming from a downtrend, and then you have a new trend here. Now, after this change of character that happened here, right? After the change of character here, price can react from this order block here and, boom, to the upside. But then we refer to this type as QMR, right? QMR. So yes, so why is A breakout block important. Breakout blocks are important because they indicate a shift in market structure. This makes them crucial point for traders to enter the market. Now, what are some important tips for trading breakout blocks? Ensure that you use breakout blocks in conjunction with other analysis, with other concepts, with other smart money concepts, right? And also trade in the direction of the trend. Ensure you are following the new trend. Ensure you are trading in direction of the trend and you're not just trading blindly, right? Guys, so let's look at the last concept before we go to our chart examples. The last concept here is inducement. Inducement, the last but not the least. Inducement simply means price moves, it's a trap actually. Inducement simply means trap, right? In trading, inducement refers to a price move that tricks traders into taking positions before the market reverses in the opposite direction, right? So it's a trap set by the smart money to get a lot of people in the trade or get a lot of people to taking the wrong position before eventually using them as liquidity, right? So we refer to them as inducement. Let's say, for example, this is the most popular type of inducement, I think. Let's say you have price, moving impulsively downwards this way, right? Now you're going to agree with me that let's say this was an uptrend, right? Or let's say this is an uptrend, right? And this is a BOS. This is a BOS, right? So you're going to agree with me that this order block here is what was responsible for this BOS, right? So what do you expect? You expect price to always come back to maybe come back to this zone here to mitigate this order block before another leg down, right? Now this is what price might do. Price might decide to do something like this and go down, right? Now a lot of people are going to be like, oh, okay, they're going to be like, okay, now we have a new swing high. But remember this our last BOS we have here. Remember when we talked about price inefficiency, right? We expect price to at least come into this demand zone before another leg down. So when you see this type of price inefficiency, something like this is an inducement. You can even see price doing something like this. This is still an inducement. Or you can just see price keep moving this way, creating series of higher highs, higher lows. And a lot of people are going to be like, okay, now we have a new trend. The price is now bullish, 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 and then price will react from this order block here and boom, it will sweep every liquidity here, right? Because all of these things was just inducement because price is not retraced, right, to this our supply zone to take liquidities before the next leg down. So all of this price just created inducement so that there will be enough liquidity to move price when it wants to go down, right? So this is how the smart money use inducement to trap traders. So how inducement works in SMC, like I already explained, to trap traders, price creates a structure that makes traders believe a breakout or a trend continuation is happening, just like I just gave us now, right? A trend continuation. And then the sweep of liquidity hitting stop losses of trapped traders, and before the real move eventually begins. All of these things will happen before this move to the downside eventually happen, which is the real move, right? Now, the common examples of inducement that we have, number one is the first breakout. Let's say price trading this way in a range, right? And then it breaks to the upside to take all of the sellers, right? And also followed by, it push to the downside as well to take both the sellers and the buyers, right? We refer to this type of breakout as a first breakout, right? And then liquidity grabs. This is when you see price just weak your stop loss, right? Just use weak to take all of your stop losses. And then we have the formal entries. Now, the formal entries is when people see, like a strong push, an impulsive move, and they'll be like, oh, okay, price is now trending in this zone, right? More like a confirmation entry. And then price will eventually come and take them out before eventually continue moving, right? And also fake order blocks. Fake order blocks are also inducement. Now, what are fake order blocks? Fake order blocks are order blocks you see in between trends. Let's say you see price, trending impulsively this way, and you're going to see maybe just one bearish candle. You're going to see a bearish candle here, and a lot of people are going to say, okay, this is another block. They will try to take trades from here, right? Most of the time, they are used as inducement, right? And also weak order blocks as well, order blocks that does not have inducement, that does not have, imbalance or did not break structure, right? Or did not break structure. Let's say something this way. They fail to break structure, right? Let's say something like this. Price will then come and do what? Price will come, take out this order block here, right? That could not create a new structure before eventually going up, right? So this is how the smart money concept use fake order blocks as inducement. So guys, now having understood all of this concept, now let's go to our chart and we'll apply all of this concept. We started with the market structure and then order blocks and then liquidity, inducement, imbalance, and breaker blocks, right? Now let's go to our chart example and see how we can apply all of these things we learned on a real life chart, right? So we pick high probability trades. Now this is a gold chart, right? This is a gold chart. Let's see where this move started from. This is a long bullish move. Where did this move start from? Okay, this is where the move started from, because from here price was actually selling. Why did I say that? Because you see that, okay, we have a break here, right? So this is where the move actually started from. So let's just focus from this zone up to the point where price is now. Now we're going to be looking out for all of these concepts we discussed in this trend. Now, the first thing you want to do is you want to identify the trend, right? The market, this is where the market structure comes in, right? Now, so what is this trend from this point here, right? You can see that this is an upward trend. How do we know this trend is upward? By the presence of the BOS, by the presence of the breakout structure, right? The higher highs and the higher lows, right? So you see here, higher highs and higher lows, right? All of these breakout structure here, right? There are so many, so I will not actually, mark all of them out, right? But you already know what I'm talking about, right? We have series of higher highs and higher lows, which makes it what? A bullish trend, right? A bullish trend. So you can decide to label it by using, BOS. You can just decide to put BOS and all that, right? Now, since we have our BOS here, and okay, we agree that this is a trend continuation, for example, right? Now, this trend started from here, so that's why we are actually paying attention from this zone, right? But we did not actually get a breakout structure until we did not actually get a change of character until price took out this high, right? Before we know that, okay, this is it. But then gold generally is a bullish market, right? So that's why we are paying attention from this zone. So let's look out for the elements of price we have here. Now, after price broke this our first high here, after price broke this first high here, right? This was the order block that was responsible. This was the order block that was responsible, right? This bearish. Remember we say, okay, the last bearish candle. You can also decide to use this one, but then this is where the move started from before this push. And you see that our order block has imbalance, right? Our order block has imbalance. The imbalance is the gap between candles, right? Now look at this. Look at the. Now we have three candle arrangement, right? This one, this tiny red candle here, this long green candle, and this one here. Now these three candles, the three candles are not supposed to overlap each other. They are not supposed to give each other space. They are supposed to overlap each other this way, right? They are supposed to, be like this, and then you use their wick to cover up each other, right? Okay, let me move this here. Let me move this way, and then move this here as well, right? Now, if they don't cover up themselves, if they don't overlap themselves with their body, then they use the wick. They use their wick, right? They use their wick to overlap themselves this way, right? To ensure that there is no space in between them, right? To ensure there is no space in between. So this is going to do something like this. Sorry about that. You're going to see something like this, right? So this is how an ideal candle setup should be like. So in a situation where you have this type of space between it, because this is where this ended, right? This is where this ended. This is where this candle ended, and this is where this candle here, this is where it also ended, right? It means there is a space here. So our order block actually created what? A space. So you can see what price did. Price came here and came to our order block and gave us a good trade, right? So that would have been our first trade. So that would have been our first trade. Would have placed our buy position here. Would have placed our buy position here, and then we use our what? We use our stop loss, bring our stop loss to this low here, right? And we target this high as our take profit. We target this high here as our take profit, right? So that's our first trade. Now, what are we going to do next? We're going to also mark out the next order block. Now, this is also the next order block, right? This is the next order block that was responsible for the another impulsive move. But unfortunately for us, price almost tapped into the order block, but price did not. It just feel this imbalance and just moved, right? And also, this would have been another valid order block. Why? Because it would have been another valid order block. Okay, let me just move this thing from here so we can see clearly, right? Look at the candle I'm talking about. It would have been another valid order block. Why? Because we also had an imbalance here, right? So it means the order that came from this zone was strong enough to push price to break this, to give us a new BOS, leaving behind imbalances, right? But then price did not come to us. Price decided to ignore us, right? And then went ahead to give us another BOS. Guys, I'm sorry about that glitch that happened. Please pardon me, right? I'm using Zoom for this recording. So like I was saying, we have we have a BOS here, right? So we expect price to what? We expect price to, you know, this will then be our new order block, but then price did not come back to this order block, right? Price did not come back to this order block, but now those that trade imbalance, right? Those that trade imbalance would have caught this trade, right? They would have caught this trade and they would have traded from here, right? But personally, I use order blocks for my entries, right? So those that trade imbalance would have caught this trade, but we that trade order block would have missed this trade, right? Now, so let's look for another trade. All right, so we have our new BOS here. We have a new BOS here, as you can see. We have a new BOS here, right? And this was the last candle, right? This was the last candle because we also have a low here. After price took out this, now after price took out this high, price retraced, right, to give us a new low. And this makes this zone our new order block, right? This is then our new order block, which means we got our new trade from here. We got our new trade from here. And so that's our second trade. And then we place our stop loss below this low here, and then we target this high here, right? So you see, we have our new trade, right? Now, all of these things here, all of these things you see here are all inducements, right? They are all inducements. That's what I was talking about, inducement. All of these highs you see here, right? So we are just using order blocks now and imbalance as our confluence for entering this market, and we are avoiding we are avoiding inducement, right? We can also use breaker blocks, but since this is a trend continuation, we can decide to just stick with the order blocks since gold is a trend continuation. Also, we have a new BOS here. We have a new BOS here. We have a new BOS here, right? And then we expect price to visit this zone, but price did not, right? Price did not visit this zone here. But instead, price decided to move from here and give a new BOS, right? Price gave a new BOS, right? Which means we have a new order block here. We have a new order block here. Or we can even decide to use this one here, right? We can decide to use this one here as our order block, right? But still, price did not come back because gold was just moving impulsively, right? So there was no much retracement on gold, right? So we have another BOS as well, another BOS. I think we'll consider, let's use another pair because this should have been another order block as well, but price did not come back. Instead, this is what price did, right? This is what price filled the imbalance. So let's say, for example, now, okay, let's consider those that are trading imbalance, for example. Let's say if we actually trade imbalance here, this is now a new trade for us, right? Would have caught this trade here, right? We'll mark out our imbalance and then we'll place our buy position and then we'll place our stop loss, below the imbalance, right? So this would have been giving us a good trade, right? This would have given us a good trade too. And also, remember, we would have gotten a trade from here as well, right? From here too. So that would have made, 1, 2, 3, 4 trades, right? So this is more like the 4th trade we'll be getting using this concept. So you can see how you can just use this to catch trades. And you know that all of these things here, I think I don't think you can see all of these things here. And you can even still be trading other pairs, right? You can still be trading other pairs while you're doing this. So price also reacted from an imbalance here, but that imbalance is not something we should consider, right? Also here as well, we have a BOS here, we have a BOS here, right? So that means this zone here is our order block. This is our order block, right? And look at what price did. Look at what price did. Price came to our order block and gave us a good trade. So this is more like how many trades now? I think about 6 or 5 trades, right? And you can see that, right? You can just see how, and then we have a new BOS here, right? We have a new BOS here. And what are we anticipating? The price is going to come back to this order block here and just give us a good trade, right? And if price doesn't come back because we see that price is, because price is impulsive here, because price is really impulsive, you might, see price after this BOS, we have a new BOS now, price has retraced. What do we expect now? We're going to look for a valid order block, but we don't have a valid order block here because there is no order block here uh with a fair value gap. Okay, look at what price did here. Look at what price did. Imbalance. Price traded from this imbalance here. From this imbalance here. So you can see without those that trade imbalance now would have caught this trade from here. Right? Would have caught this trade from here to the upside, right? And then we that trade order block and look at this imbalance here, yeah? This imbalance actually broke this structure. This order block, sorry, this order block broke this structure here, broke this structure here with imbalance, right? Look at these candles here, these 3 candles. This last candle has an imbalance. So what price came back to the order block. So you can see how many trade would have possibly caught with all of these things. All right. And you don't even have to stress yourself over a particular, you can just decide to go to another pair, right? You can decide to go to, let's say, GBP, USD, NZD, any pair at all you want, and you can, trade this strategy and make good money for yourself, guys. So, guys, if you still haven't subscribed, please go ahead and click on the subscribe button and also click on the like button as well. I hope you found value in this video. Please go to your chart and back test this strategy, right? I'm going to leave a quiz in the comment section just to test your knowledge or your understanding of this concept that we've discussed so far, right? So guys, see you in the next video. Peace.